For people that have saved significant sums of money into a 401k, one of the most common questions I see is how much will my RMDs be and how much will I be taxed on the withdrawals. So in this video, I'm going to explain everything you need to know about your RMDs, what RMD amount you can expect, the associated taxes to expect, and what you can do to plan around these withdrawals to be as tax efficient as possible heading into retirement. My name's George, I'm a CPA and owner of Seam Financial, where we help retirees and pre-retirees with all their financial planning needs. So let's start with how RMDs, or required minimum distributions, work. Quite simply, the IRS puts in place a set year where you have to make a minimum distribution from your traditional IRA or 401k plan. These are your RMDs. 2026, the age at which you have to take your first RMD is 73. However, there are some rules in place that allow you to either take your first year's RMD either at any point in 2026 or delay it to April 1st of the following year. If you do delay, you would still also have to take your second RMD by December 31st of the same year, meaning you would have two RMDs in 1 year, which often isn't ideal from a tax planning perspective. It's also worth noting that the future RMD age will increase to 75 in 2033. So let's go through an example. You turn 73 in 2026 and have a 401k balance of $2 million. To calculate your RMD for this year, you take your total 401k balance and divide it by the IRS set distribution period, which you can see here. For age 73, this is 26.5. In this case, we end up with around $75,472. This amount will be taxable as ordinary income upon withdrawal. So let's see what the tax impact of this will be. We'll assume a married couple with combined social security of $60,000 per year and no other income. Now we need to keep in mind how this RMD not only is taxed in isolation, but also how it affects our social security taxes. To do this, we use a figure called provisional income. This is the amount that determines how much of your social security is considered as taxable income. To reach this figure, we take our RMD amount plus 50% of our annual social security payment, which gives us a provisional income of $105,472. Now that we have this figure, we can apply the specific social security federal thresholds to work out how much of our social security is taxable. For our first $32,000 of income, social security is tax-free. 50% of our social security is considered taxable for the next $12,000 of income, and 85% of the remaining $61,000 is taxable, giving us a taxable social security of $58,251. Now this figure using our provisional income is then compared to a flat 85% of our social security benefits, which would be $51,000, and the lower of the two is taken, meaning that $51,000 of our social security is considered taxable. So now to get our total adjusted gross income, we take our $51,000 of taxable social security plus our RMD of $75,000, giving us an adjusted gross income of $126,000. Now let's assume we take the standard deduction of $32.2K for 2026, as well as our senior deduction of $6K and our 65 plus deduction of $3.2K to give us a total taxable income of $85,072. We then apply our federal tax rates as follows to give us a federal tax of $9.7K. So obviously your situation will be different, but I hope this has helped you get an understanding of how RMDs and the tax implications are calculated. Now something important to note here is that our $75K RMD represents around 5% of our total 401k portfolio value. For each subsequent year, the distribution period that we use to calculate RMDs actually decreases, meaning a larger portion of your portfolio is considered as an RMD. Add to this that assuming a fairly prudent portfolio growth rate of, say, 5 to 6% a year, our portfolio, especially in these initial few years of lower RMDs, will likely grow at a similar, if not greater rate than the RMDs that we'd be taking out. All of this to say, it's worth crunching the numbers and planning for what in all likelihood will be higher subsequent year RMDs when trying to figure out your approach and tax planning strategy. Because a higher RMD means a higher income, higher tax, larger impact on your social security, and potential impacts on Medicare premiums. Now, before we get into the methods to potentially reduce RMDs, I just want to take a moment to make the point that RMDs seem to cause a fair amount of concern amongst the retiree community. Understandably, you see this large sum of money that has to be withdrawn and you're concerned about the tax associated with this. It's worth just keeping in mind that in many situations, RMDs, 1, do not meaningfully affect your tax situation to the extent where your retirement plan is going to be materially impacted. And 2, you are going to be drawing down from this account with or without RMDs. There is no difference in the core tax treatment of an RMD compared to standard non-RMD associated drawdowns. You're going to be paying income tax on the withdrawals you make from these pre-tax accounts, and this is going to happen regardless of whether this is from an RMD or not. You can see even in this scenario where we have a fairly sizable account of $2 million, our RMD, even when taking into account the taxable Social Security payment, doesn't even push us above the 12% federal tax bracket, which is actually more tax efficient than, say, long-term capital gain rates at this current income level, which would be 15%. Post-tax accounts, like Roth accounts, also tend to be an account that you want to let grow as much as possible and leave as untouched as possible during early retirement. So if we need to draw down income from somewhere to supplement Social Security payments, which is normally the case, drawing from our IRA via RMDs, like in this scenario, is really not an issue, and if anything, is a pretty tax efficient way of doing it. So I just wanted to make that clear to dispel some of the more sensationalist opinions out there about RMDs that often unnecessarily scare retirees about this whole process. With that being said, let's quickly talk about some methods to reduce RMDs. First is to tweak our separate account holdings to more tax efficiently reflect our desired portfolio coverage. Let me explain. You'll hopefully have identified the appropriate allocations of security holdings based on your risk tolerance as you enter retirement. This will of course include a percentage of your overall portfolio allocated to stocks versus bonds, etc. Now, a common situation is to have a 401k/IRA and a Roth account, and oftentimes both of these accounts reflect the same allocation based on the aforementioned risk tolerance that you have. Now, if we're looking to reduce RMDs and overall tax burden from withdrawing from our IRA or 401k account, it's worth considering whether a high percentage of your lower risk, lower return type securities like bonds, cash, etc. should be concentrated within your pre-tax accounts, and a higher percentage of the higher growth potential equity funds to be held in your Roth account. The obvious reason being there is no tax on withdrawals from Roth accounts, so we want to expose our holdings here to the most potential growth as possible. Now, you can still achieve the same overall holding coverage, but just concentrated differently between the two accounts. Now, there's of course the risk of equities underperforming during a down market that would of course negatively impact your Roth holdings, and the kind of natural hedge here being that in general, tax efficient withdrawal plans tend to withdraw from the Roth accounts last, or at least later than other accounts like your 401k, which inherently gives the account more time to bounce back from the down markets over a longer period of time. Next is to reduce your RMDs through Roth conversions. The key benefit here, above the benefit of increasing your post-tax account balance, is that Roth accounts have no RMDs. So by converting, we reduce the overall value of our 401k, which will in turn reduce the RMDs calculated on that account with no associated Roth RMDs. Now, to reiterate the point made earlier about not being too scared about RMDs, Roth conversions will only benefit you if your tax rate upon conversion is lower compared to when you would otherwise draw down from the account. If not, all you're accomplishing here is reshuffling funds and paying the IRS tax earlier than you need to, which of course negatively affects our overall financial position. The key here is to have a clear understanding of what future income levels you expect so you can make a clear decision as to whether a Roth conversion is the right move to make. Now, in our situation where our couple are at the 12% federal tax bracket, there may be a fairly strong argument for Roth conversions, considering that there's very little likelihood of them moving down a tax bracket in future years. But as always, this depends on what their projected annual income goals are going forward in retirement. The key when making decisions surrounding RMD impact, Roth conversions, and overall financial planning is to look at the situation holistically and over a realistic period of time. If you're interested in discussing any of your retirement or general financial planning questions with me personally, please see the link in the description to schedule a free, no strings attached consultation. Thank you all so much for watching. Please make sure to like and subscribe, and I'll see you all in the next one.